Hello, everyone. Welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over bonds. We're going to be looking at Treasury bonds. We're going to be looking at corporate bonds on the 10-year, the 30-year, all different types of things like that. I don't like to cover bonds on my channel very often because not a lot of things change in the long run with Treasury bonds, but I think it's good to go over them, and I like to cover them on my channel at least about once a month just to keep you guys familiar with it, give any updates, any price movements, or any changes that the Fed might be doing to try to update the yield on bonds. So overall, guys, in this video, I'll be going over two different articles from CNBC, one titled Retirees Might Want to Rethink the Reliance on Treasuries for Income, and the other one is Interest Rates Are Expected to Stay Near Zero for Years. Hear why that's good and bad news. And then I'll also be comparing Treasury yields and corporate bond yields to my portfolio. I currently have 27 different holdings. Those of you that follow along with me know my holdings, and I have 27 that yield currently about 3.525%. And then after that's all said and done, I want to give an update on my REIT section of my portfolio. I'm currently considering bumping up WP Carey. I'll give my reasons why in this video, and then both of these stocks on the same day announce a raise in their dividend. So I'll be going over their dividend raises, their dividend yields, and I'll also be going over the amount of rent that they've collected previously in the last few months. So overall, guys, it's going to be a good episode. If you're not familiar with me, my name is Jordan. One of the ways that you can support me and my channel is to go ahead and sign up using this referral link in the description. This link right here is in the description. You get $20 for signing up. All you got to do is download M1 Finance. It is absolutely free to use, no fees whatsoever. And if you deposit $100 or more to the platform, you'll get $20 for signing up. And that promotion ends about a week from now, from the time I'm filming this video. So if you want to go do that, go ahead and sign up for it now. And my portfolio is doing very good. And at the end of the video, like always, I'll give a quick update on my portfolio. But let's go ahead and look at Treasury bonds. Let's click the research tab here, and let's click funds. Let's click bonds. Let's go down to domestic. And then let's go ahead and start with, actually we'll start with corporate. We'll go ahead and start with corporate bonds. And what we're going to focus on is investment grade. We're not going to focus on a bunch of high yield junk bonds. This is the largest ETF for investment grade corporate bonds, LQD. And it currently has a dividend yield of 2.9%. And look at the upwards move of this ETF over the last year or two. In 2018, this was a $111 ETF. Today it's at 134. This ETF usually yields around 4%. Right now it's only yielding 2.9. So if you're an income investor, if you're looking for yield, if you're looking to receive cash flow from your portfolio, you're not getting nearly the yield you used to. Now let's go back to the research tab here. Click funds. Let's go ahead and click bonds. Let's hit domestic again for the US. Let's click government this time, and let's focus on long term. I want to focus on long-term treasuries. One of the ones that I always like, my favorite, you guys that follow me know, EDV and VGLT. These two right here are my favorite. And let's go ahead and look at VGLT. It currently yields 1.89%, less than 2% dividend yield. And this was a $69 stock 2 years ago, back in 2018, and today it's over $100. So once again, these usually yield 3, 4, even sometimes in high interest rate areas around 5%. This is yielding under 2, so just keep that in mind. So let's go ahead and go to this article here. Retirees might want to rethink their reliance on treasuries for income. And there's 3 bullet points here. The yield on 10-year treasury bonds and those with shorter durations is below 1%, a 1% yield. If inflation is above what you're earning in treasuries, that part of your portfolio loses buying power. There could be a better way to allocate your portfolio to ensure the value of your assets isn't eroding. So to go ahead and wrap that up there, that is pointing out if you're older, if you're wanting to get yield in your portfolio, or if you're just wanting some kind of safe haven, you're actually probably going to be losing money on this investment off the yield because interest rates are so low and because inflation is going to probably outpace that of what the yield of the treasury bond is. Now let's go ahead and scroll down here, and you see this chart. And this is the history of interest rates from 1960 to 2020, a 60-year period. And back in the 1980s, things were awesome. If you were investing in treasury bonds, there was never a better time to invest in them. 14, 15, 16% interest rates, and bond prices are at rock bottom prices. Now, since then, since 1980, we've went nothing but down. You see the blue is the 1-year line, the 5-year line is dark blue, and then the black line at the 10-year. Over the last 40 years, we have went down and down and down and down and down in yield, and when the yield goes down, the bond prices go up. And there's something I want to point out now, going to my next article. Interest rates are expected to stay near zero for years. Here why that's good and bad news. So interest rates are going to stay at rock bottom prices, pretty much at zero. The good news is, if you're wanting to buy anything, if you're wanting to buy a home, if you're wanting to buy a vehicle, if you're wanting to invest in stocks, things are pretty cheap. You can borrow money pretty cheap for pretty much anything, a lot cheaper than you could have at any other time in history. And when people are being encouraged to spend money, theoretically stocks are going to go up even higher as if they weren't encouraged to spend money with lower interest rates. Now, here's why that's bad news. If you're wanting to get a hedge, if you're wanting to have a derivative of some sort, if you're wanting to have a treasury bond as a safe haven in your portfolio, having treasury bonds is not a very appealing thing right now. So let's go ahead and look at the S&P 500 here. Let's type in SPY and let's look at its dividend yield. If you're investing in the S&P, right now its dividend yield is 1.76. Okay, well let's go ahead and go back to EDV. Let's go ahead and get, or VGLT is the one we were looking at. Let's look at VGLT. VGLT yields 1.89, almost identical to that of the S&P 500. So you know with treasury bonds that your payout is not likely going to be rising any significant amount. But with stocks, your long-term outlook is that stocks are going to be raising their dividends as people are being encouraged to spend, as they're getting more profits, as they innovate their business model, and then just overall the economy grows. But regardless, if you're investing in stocks, you always know stocks are going to outperform long-term treasuries. But if you're investing in long-term treasuries, you have them as a safe haven investment. You want to get yield off of them and then protect yourself from crashes. And if you're investing in LQD, if you're investing in corporate bonds, you want some pretty good yield. You want at least a 4+% yield. And the fact that you're getting less than 3% now, and the other day it was actually like 2.5 after this little spike up. If you're getting less than a 3% yield, that's not a very good yield to incentivize you to invest in corporate grade bonds. So anyways, guys, I think that a lot of the upside potential is pretty much gone, especially since interest rates right now are at zero. And the Fed has came out and said that interest rates are going to stay at a 0% level for pretty much years out to come. And that's what this article is talking about. If you're wanting to invest in treasury bonds, there's pretty much nothing but downside potential. I like to focus a lot on yield. I like to focus a lot on dividends, but you do have to focus on the actual price you're buying things as well. Theoretically, if I were to guess the prices of these bonds a year, 2 years, 3 years from now, if I were a betting man, this stock price is going to be under $100. It will probably be $90, $80, $70 a share, and I don't think that's a very good investment right now, considering that you could buy stocks, and especially right now from the time I'm filming this, they're at about a 10% correction from where they were from their all-time highs. They previously went up to about $350 a share, and then they're now down to $324. So they have went down in share price, and what you can do is invest in them now while we're having a little bit of a correction and stay away from bonds in my opinion. So in my portfolio, I am not invested at all in treasury bonds for now. I am 100% in equities, 100% in stocks, and these are the 27 holdings that I have. Like I said, this portfolio is also shared in the description, by the way, if you want to invest in this or look at it yourself personally. But these are the 27 companies that I own. And one of the stocks that I'm considering bumping up is WP Carey, right here, 4%. It is actually my worst performer. If we sort here by my best performers, right here, and then we sort by my worst performers, it is my worst performing stock. Now they just raised their dividend again. I'm about to show you those numbers in a second, but right now it is yielding 6.5%. Now a lot of people, when they see that number 6.5%, think, oh gosh, that's not safe. They're going to cut that dividend immediately. They just raised it, and I think that they're going to continue to keep that dividend yield for a while, and they actually claim their dividends, I believe like today actually. But WP Carey is a safe 6.5 yielding stock, and I'll give my reasons why for that. So let's go ahead and look at my portfolio as a whole, not just WP Carey, but with all 27 holdings, my portfolio currently yields 3.5%, over 3.5%. But those long-term treasuries yield under 2%, and that LQD bond, like I said, yields under 3%. So the fact that you can get less than 3% investing in an ETF, and the fact that you can invest in my portfolio for a 3.5% yield, much higher yield than LQD, much higher yield than VGLT, any treasuries, corporate bonds, you can invest in my portfolio for a growing dividend since they're equities, growing stocks, growing portfolio that will have a higher dividend yield than that of anywhere else in the market, but it's still a safe dividend yield. And that is excellent in my opinion for people that are not only wanting to grow their income, but are wanting to get current income as well at 3.5%. But regardless, let's go ahead and go to the two stocks that I'm analyzing in this video. They are both REITs. I want to focus on 2 of the 3 REITs that I own. The 3 REITs that I own are Realty Income, which is one that we're going over, WP Carey, the one I just showed you, and then I also own Store Capital. But I'm looking at bumping up WP Carey, and I'll show you why right now. So let's go ahead and take a look at Realty Income. Realty Income raised their dividend payment from this amount at $0.2335 a share up to $0.2334 a share. Now, this stock does not raise dividends massive amounts, but it has an incredible track record. This stock does not pay out dividends quarterly. They pay out dividends every 30 days, every single month. And they do not raise their dividend every year. They raise their dividend at least, the key word there is at least, sometimes more, but at least every quarter, every 90 days. And they usually do small dividend raises, but this really adds up over time. And this is the 108th dividend increase since Realty Income's listing on the New York Stock Exchange in 1994. Now, their previous payment was $2.80.2, and it is now up to $2.80.8. Now, let's go ahead and look at their dividend history. I went ahead and went online, went to Realty Income Investor Relations page, and I looked at their dividend history. And I have to say, it is really impressive. But 7.5 cents in 1994, and I'm just going to scroll through this list real quick and look at two things for me. One, I want you to look at the consistency of these dividend payments. Look how consistent these payments are. They do not stop pretty much ever, and that's even factoring through stock splits, that's factoring in from recessions, that's factoring in through all the hardships that they have with their company, downturns in the economy, global recessions, whatever the case may be. The consistency of these payments is nonstop. Since 1994, when this company has went public, they have not missed even one payment, not one. Every 30 days, like clockwork, at the end of the month, they claim their dividends and then pay them out about 2 weeks later. Now, if you notice, as you've been looking at this left column here as I scroll through, the dividends are constantly being raised. Even as the stock splits, the dollar amount goes down, but the amount of dividends being paid has went up dramatically over the last 20 or so years. So I think Realty Income will continue to hold up that streak, and I don't think that it is going to be stopping anytime soon. And there's a couple reasons why I think that. First off, their rent collected as a total portfolio for the quarter ending their second quarter in June 30th of 2020. They collected 87.8% of rent. Not anything that is incredible considering it's the worst recession in history. That's still pretty good. Now let's look at how things are improving. For the month ending July 31st, they went up to 92.3. Okay, looking a little bit better. Let's go ahead and look at August 31st. Let's go ahead and go to the previous month, just a couple days ago. They had 93.5% collected across their entire portfolio. Now remember, we're coming out of a recession. Now normal times, when we're in a bull market, we're in a thriving economy, this stock typically receives about 97, 98, 99+% of its revenue in the form of rent being collected every single month. So considering that they're still getting over 93% of the rent being collected in the worst of all recessions is still a pretty good sign, and they paid out those dividends every single quarter, every single month like clockwork. And that is what has led this stock to return a 15.3 average annual return since 1994. Now, Realty Income is an excellent stock, but it's not the only REIT that I own. Let's go ahead and look at WP Carey and look at how it holds up. Now, comparing the yields to WP Carey to Realty Income, if we click it right here, currently yields 4.7%. Pretty impressive, but comparing that to WP Carey, instead of 4.7, this yields 6.5%. Over 6.5%, and is down today, so it's actually even a little bit higher than this number right here. And I don't even think that's actually even factored in the dividend yield that has been raised in the last week or two. So I think that's actually like 6.7, 6.8%. But regardless, let's go ahead and look at this article. So they had net income of $105.3 million or $61 a share, but this number right here is what is really important. If you're investing in REITs, earnings per share is not nearly as important as funds from operation. So adjusted funds from operations, or AFFO, was $197.9 million or $1.14. Now they're currently paying out $1.04. So they're making more than what they're paying out. REITs are obligated to pay out 90% of their net income in the form of dividends, but they're still making more than what they're paying out in dividends in a recession. So they must be collecting still an incredible amount of money even throughout this recession. And if you're thinking that, you would be right. So let's go ahead and look to this bullet point right here. And this is pretty much all I have left for WP Carey. Overall collection rate of 96% for 2020 second quarter. Now the second quarter was the worst quarter of 2020. Worse than the first quarter. And they still collected 96% of rent. I'm going to say it again. 96%. That is incredible. And then in July, just 2 months ago, they collected 98%. And in August, it was the same as well. So they're still collecting 98+% of their rent, even in the worst of recessions. So I think this dividend is maintainable. And they just raised that dividend from $1.04.2 to $1.04.4. So a small raise there. And the reason why they have such an incredible dividend yield and an incredible dividend growth is primarily because of this portfolio. If you look at the diversification, they're not only in the United States, they're in other countries as well, and they're in a ton of different industries. But if you're not convinced, let's go ahead and look at some of their top holdings and see some of the companies that they have. Now, they're diversified between tons of different companies, tons of different businesses, and 3.4% is their highest client. So if this client stopped paying rent, it is only a 3% risk, and their lease terms is very long, many of them in the double digits, like this one, 16 years, 14 years, 9.9 years, 23 years, 23 years, 23, 12, you get the point. Now, if we go ahead and scroll up here and we go to property type diversification, there's all different types of properties here. It's not just retail or it's not just office, whatever. It's diversified between industrial, warehouse, office, retail, self-storage, and other. They have multiple categories, with every single category making up a fourth or less of their portfolio. So if one category really starts to struggle, it's only a small part. And if we go to their industry diversification, a lot more different industries. Their highest one being retail at only 22%, not a very high percentage target there. But overall, guys, that's why I'm really bullish on REITs. That's why I'm really bullish on Realty Income, why I'm really bullish on WP Carry, and I'm considering bumping up WP Carry in my portfolio. But regardless, if you're wanting to invest in bonds, whether it be corporate bonds or long-term treasuries, I don't really think that now is the best time to invest in them. And investing in junk bonds is something I think that you should really never be doing, as I don't think they tend to perform as well as a lot of other bonds. We can go ahead and just look at the performance real quick for junk bonds. We click bonds, domestic, corporate, and then we click high yield. Let's go ahead and look at the highest yielding ETF, and you can see the 5-year performance is actually down because junk bonds typically don't give you the type of performance that you need for the long term to not only grow your dividend but increase in share price. But overall, guys, thank you so much for watching all the way to the end if you made it this far. I've had 38 people now sign up. We got one more this morning, up from 37. Go ahead and get that number, please, up to 39. And if you want to go ahead and follow along with me on my journey, this is how I track my annual and monthly dividend income, as well as my portfolio value and my monthly YouTube income, and there it is broken down by category. But if you want to go ahead and follow along with me in my journey, I would invite you to subscribe, and you can follow along with me and maybe even invest in the same stocks that I'm in if you're interested. But thank you guys so much. Leave a comment down below if you have any questions for me about bonds or about my portfolio in general. But other than that, guys, I will see you guys next time.